So here's a fun fact. In Canada, the average home now costs about 12 times the average household income. 12 times. It's not a typo, that's not an exaggeration, that's just reality. For context, back in the 1980s, that number was about 3 to 4 times. But hey, at least Canadians are polite about getting financially destroyed, right? Welcome back to another episode where we explore how an entire nation looked at one asset class and said, yeah, let's put all our economic eggs in this basket. What could possibly go wrong? Today, we're talking about Canada's real estate obsession, a love affair so intense, so all-consuming, that it's basically turned the entire economy into a glorified housing market with some Tim Hortons locations sprinkled in for flavor. This isn't just about expensive houses. This is about how a G7 nation managed to transform itself into what economists are now calling a real estate market masquerading as a country. We're going to break down how this happened, who's responsible, why nobody seems able to fix it, and what it means when your entire economic growth strategy is basically build more condos and pray. Spoiler alert, the prayer didn't work. Let's rewind to the early 2000s. Canada had just dodged the worst of the dot-com bubble. The economy was stable, interest rates were reasonable, and housing was affordable. I know, wild concept. A starter home in Toronto could be had for under $200,000. Vancouver was pricier, sure, but it wasn't the financial death trap it is today. But then something magical happened. Canadian policymakers looked south at the United States and thought, you know what? That whole everyone should own a home thing looks pretty good. Let's do that, but with more apologizing. The Canadian Mortgage and Housing Corporation started loosening lending standards. Banks were suddenly offering 40-year mortgages with 0% down. 0% down. You could literally buy a house with nothing but vibes and a decent credit score. Meanwhile, the Bank of Canada kept interest rates low, really low. Post-2008 financial crisis, they dropped rates to emergency levels and then just kept them there for over a decade. The logic was simple. Cheap money stimulates the economy, and stimulate it did, just in the most lopsided way imaginable. Here's where it gets interesting. Unlike the United States, Canada didn't really have a housing crash in 2008. Prices dipped slightly in some markets, then bounced right back. Canadian politicians and economists patted themselves on the back and declared victory. See, they said, our banking system is so much more stable. We're basically immune to housing bubbles. Narrator voice. They were not immune to housing bubbles. Instead of learning from America's mistakes, Canada looked at the rubble of the U.S. housing market and thought, but what if we did that on purpose? The government explicitly made housing a pillar of economic growth, construction jobs, mortgage lending, real estate commissions. It was a beautiful, self-reinforcing cycle of wealth creation. Except it wasn't wealth creation. It was debt accumulation with better marketing. Now, starting around 2010, cities like Vancouver and Toronto became the playgrounds of international capital. Wealthy buyers from China, the Middle East, and other countries started parking their money in Canadian real estate. Canada offered political stability, relatively lax disclosure laws, and a housing market that only went up. It was like a savings account that you could also live in, except you didn't even have to live in it. Vancouver was ground zero. By 2015, stories were everywhere about homes being bought sight unseen, in cash, often by shell corporations. Entire neighborhoods filled with dark windows. $1 million homes sitting empty while local families were priced out. The Canadian government's response? A 15% foreign buyers tax in British Columbia, eventually raised to 20%. And you know what happened? Prices kept rising. But here's the kicker. Blaming foreign buyers became the convenient scapegoat. The reality? Foreign ownership probably accounted for about 5 to 10% of purchases in hot markets. The real culprit was Canadians themselves, treating homes like stock portfolios, buying investment properties, flipping condos, taking out home equity lines of credit to buy more real estate. The call was coming from inside the house, so to speak. Let's talk numbers, because the numbers are absolutely bonkers. As of 2024, Canadian household debt-to-income ratio sits at about 180%. That means for every dollar Canadians earn, they owe $1.80. For context, the U.S. peaked at about 130% before their housing market imploded in 2008. The average mortgage debt in Canada is now over $300,000. In cities like Toronto and Vancouver, it's well over $500,000. And these aren't 30-year mortgages like in the States. Most Canadian mortgages are structured as 5-year terms that get renewed, which means when interest rates go up, homeowners feel it immediately. And, oh, did interest rates go up. After keeping rates near zero for over a decade, the Bank of Canada started hiking aggressively in 2022 to fight inflation. Suddenly, people who had gotten comfortable with 2% mortgages were looking at renewals at 5, 6, even 7%. Monthly payments doubled, sometimes tripled. So what did people do? They tapped into their home equity lines of credit to make their mortgage payments. They used debt to service debt. It's the financial equivalent of drinking seawater to quench your thirst, except the seawater costs 6% interest. Meanwhile, the rental market became a horror show. With home ownership out of reach, everyone was competing for rentals. Stories emerged of 40, 50 people showing up to view a one-bedroom apartment. Bidding wars for rentals. Yes, bidding wars for the privilege of paying someone else's mortgage. The dream of homeownership, dead for an entire generation. The average age of a first-time homebuyer in Canada is now 36. Here's where the real estate trap shows its teeth. When housing becomes your economy, everything else suffers. Canada's productivity growth has been abysmal. We're talking worst in the OECD kind of abysmal. Why? Because instead of investing in innovation, businesses, or infrastructure, Canadians were investing in more condos. Young, talented Canadians started leaving. Brain drain became a real problem. A software engineer in Toronto might make 80,000 Canadian dollars while paying $2,000 a month for a one-bedroom apartment. That same engineer in Texas could make 120,000 US dollars, pay $1,200 for a nicer place, and actually save money. The choice wasn't hard. Canadian banks, meanwhile, became almost entirely dependent on residential mortgages. Over 60% of Canadian bank lending is tied to residential real estate. Canadian banks are basically mortgage companies that also offer checking accounts as a side hustle. This created a perverse incentive. Banks needed housing prices to stay high to protect their mortgage portfolios. The government needed housing prices to stay high because construction and real estate made up a huge chunk of GDP. Homeowners needed prices to stay high because their net worth was entirely tied up in their homes. Everyone was trapped in a collective delusion that prices could only go up. Now, let's talk about immigration. Canada has been bringing in roughly 400,000 to 500,000 immigrants per year, incredibly high for a country of 40 million people. The stated goal? Economic growth, filling labor shortages, supporting an aging population. All good intentions. The problem? Nobody thought to build enough housing for these people. The government set immigration targets that required building hundreds of thousands of new homes annually. Actual housing starts? Nowhere close. It's like inviting 500 people to a party at a venue that holds 200 and then wondering why it's crowded. And here's the cruel irony. Immigration became a scapegoat for the housing crisis. Too many people, citizens would cry, as if the immigrants themselves had written the zoning laws that restricted housing supply. The reality was much simpler. Canada wanted the economic benefits of population growth without making the infrastructure investments required to support it. So surely the government stepped in to fix this, right? Oh, you sweet, optimistic soul. The problem is that fixing the housing crisis requires making homeowners less wealthy on paper, and homeowners vote a lot. Politicians looked at this and decided that career suicide wasn't really their thing. Every proposed solution got watered down or blocked. Zoning reform, rejected by local councils controlled by homeowners. Vacancy taxes, set so low they were basically suggestions. Foreign buyer bans, implemented after foreign buyers had already moved on. Meanwhile, NIMBY culture reached peak absurdity. Neighborhoods fought against apartment buildings because of character. Translation: we don't want more housing because it might make our houses slightly less obscenely valuable. By 2023, the cracks were becoming chasms. Rising interest rates finally started to bite. Housing prices in some markets dropped 10, 15, even 20% from their peaks. Sales volumes collapsed. Listings piled up. The frenzy was over. But here's the thing. Prices falling isn't actually a solution when everyone is neck-deep in debt. Banks tightened lending standards dramatically. The very people who needed price corrections to afford homes couldn't get mortgages anymore. It was the worst of both worlds. An economic slowdown without the market correction that might have actually helped young buyers. So, what have we learned? First, when you build an entire economy on one asset class, you're not building an economy, you're building a house of cards. Second, low interest rates are a drug. They feel great in the moment, but the withdrawal is brutal. Third, immigration is good actually, but only if you build the infrastructure to support it. Fourth, NIMBYism is a luxury belief. When wealthy homeowners block new housing to protect their property values, they're essentially pulling up the ladder behind them. Here's the kicker. Canada's housing crisis is essentially unfixable in the short term. You can't build your way out of a decades-long supply shortage in 5 years. You can't meaningfully reduce prices without destroying homeowner wealth and triggering a financial crisis. You can't keep prices high without pricing out an entire generation. The country is stuck. The trap has closed. Canadian politicians have shown zero appetite for the kind of bold reforms required. The most likely outcome is that housing remains unaffordable for a generation. Productivity continues to lag, talent continues to leave, and the economy remains overly dependent on real estate until some external shock forces change. Canada's housing crisis is a masterclass in how good intentions, perverse incentives, and political cowardice can combine to create a disaster in slow motion. The Canadian dream used to be a good job, a nice house, and a secure retirement. Now, it's a good job, a rental apartment, and hoping your landlord doesn't raise the rent again. And the most Canadian part of this whole disaster, everyone's still being polite about it. Sorry, you can't afford a home. Sorry, you'll be renting until you're 40. Sorry, we turned the entire economy into a real estate Ponzi scheme. At least we're apologizing while the whole thing burns down. Thanks for watching.